Hello and welcome to a brand new show of Market Makers. 2018 up until now has been a year of excitement and disappointment. Excitement and disappointment, they both have coexisted. We were off to a dream start, then came the mid-air turbulence. Markets made a comeback, but mid-cap stocks are struggling. Crude at $78, bond yields are inching higher, but Nifty is not far away from an all-time high. That's a good part. The bad part is selling has intensified in small and mid-cap stocks. Is it time to pick up bargains, or 2018 could be a tumultuous year of high volatility? So how should one invest, pick up bargains in this kind of a market where the mid-cap stocks are once again giving you opportunity to invest and put money to work? So discuss all that and much more with me. I have a mid-cap specialist, someone you've seen before on Market Makers, Ravi Dharamshi of ValueQuest. Ravi, fantastic to have you back and thank you for joining us.
Thank you, Nikunj.
If I'm a Nifty watcher, this is a great and a dream year for me. Nifty is kadak, despite whatever could go wrong, has gone wrong, Nifty is strong. For small and mid-cap investor like you, this would have been a challenging year. A little bit of sweat on the brow should have come.
No, it's always a challenging year. But I think Uday Kotak had put it very succinctly. This is the time where the macros are struggling, but the micros are actually just picking up. So there is a lot of opportunity to pick up good companies where there is a lot of tailwind. So it's, however, I mean, we should be worried that crude is going up, bond yields are inching up, inflation has bottomed out. There are many reasons to worry. But if you see, the macros were improving from 14 to 17, and those macros are now converting into good macros. So a lot of companies are developing good tailwinds. The growth is actually coming back. The rural economy is doing well. We can see so many high frequency data of consumption, which tells you, I mean, what are we talking about over here? There's no rural distress, no consumption shrinkage or any of those things. The utilization for companies are moving, inching up from 70% to 80, 85%, and that is leading to a lot of operating leverage. Financial deleveraging is happening at the company level. So I am actually quite optimistic from a stock picking point of view, but I think what 2017 was, that one huge wave that picked up all the boats, that's gonna be missing this year. It's gonna be more selective and more stock picking oriented.
There is an opinion floating around in the market that PMS fund managers are feeling the heat now. Some are writing to their clients also, some are indicating to their clients also that, look, it's been a tough year for us. What's been your experience?
Touch wood, we have avoided the landmines. Not to say that we are doing way better than the market or any such thing, but none of those bombs that have exploded in the market have been in our portfolio. So that's the good part. And definitely a challenging time because of the margin increase, because of the rally previous year. There is a lot of money that flowed in last year, and that hasn't seen returns. So that by itself will put a lot of pressure on the mid-cap, small-cap space. But that is a generalization. Within that mid-cap, small-cap space, can you find 10, 20, 30 stocks that can deliver good returns even from here over a 2-3 year period? I think we can. So you have to avoid those landmines. That's rule number one. Rule number two is then you have to look for companies where there is a good risk reward even from here with a 3 year point of view.
So are you of the view that this year, forget about chasing growth, let's keep it safe, let's keep it simple, buy companies where the downside is less, the upside could be capped, but if the downside is limited, you may lose less?
No, I would just put it in a different way. Don't chase growth where the growth is very visible and obvious. Go for places where the growth is yet to come. The growth is in 19 and 20. Those companies which are not growing today, but where the macros are changing in their favor. Let's say, for example, rupee is depreciating, then there is a tailwind developing for exporters, for example. Utilization levels of companies are going up to 70, 75, 80%. That means the capex cycle is coming up maybe a year down the line. So those are the places where one should look at and position yourself for growth that is going to come in FY20 and not the growth that is happening in FY as we speak today.
You have this reputation of being a farmer bull. How would you defend that reputation now?
Why should I defend the reputation? I mean, again, we have been lucky to avoid all the explosion that has happened. Our allocations have come down significantly, and we have remained only with the stories where we believe that there is significant upside on an absolute basis even from here with a 3 year point of view. So touch wood, but my portfolio does not reflect 100% pharma, what has happened in pharma.
So you like pharma, but you like pharma selectively. We should not brand you as the pharma bull on D Street.
No, no, it's just that we got lucky from 2010 to 15. The best space was pharma, and we rode that wave very well. I won't claim that we've avoided or completely gotten out of it post that, but it's okay. The damage is limited, and our winners are still holding on to a substantial gains.
So let's say if you would have, I'm going to take the clock first back, and I'm going to take the clock forward after that. Let me take the clock back. May 2017. What was the construct of your portfolio, and what is the construct of the portfolio now? What has changed in terms of positioning, ideology, and approach?
Yeah, so very rightly, we have reduced weightage in pharmaceuticals. We have the theme that we are positioned, or in the last 12 months, we have increasingly positioned. 12 months back, we added a lot of consumption stock, rural consumer theme, companies that were undergoing trouble within the consumer space. That's what we added 12 months back. Today, obviously, they are doing very well. But from this point onwards, I'm trying to position myself in small cap IT, mid cap IT, and particularly product companies. Even in capex of the side, we are positioning ourselves on the product side. Then there are in the financial inclusion theme, where some sector has undergone trouble in the last year. So all spaces which are not doing very well as of today, but are anticipated, where we feel that 12 months down the line, 18 months down the line, they'll do well. That's where we are positioning ourselves.
Okay, so let's just to revisit the themes you are betting on.
Yeah.
You are betting on small banks.
Small banks.
You are betting on capex, but you are not buying road companies, or you are not buying construction companies. You are buying ancillaries, the second derivatives, like pump companies and companies on those categories.
Correct.
And you are selectively betting on IT product companies.
Yes.
Okay. Let's take a deep dive now.
Sure.
Why do you like IT product companies? Because we've seen a lot of excitement with some of these product companies earlier also.
Yeah.
Somehow none of them have lived up to the promise and reputation.
You're absolutely right. I think we had an entire dot-com boom which lifted the services model, and what we saw in the dot-com era and the sizes that these service companies have become is humongous as compared to what an IT product company is. They have remained at 80, 100, 120 million dollar kind of size. So actually the boom has not happened for the product companies. Now this is a long gestation business. It requires you to invest continuously in developing those products over an 8-10 year period. Now today we can say they have reached a place where they have the marquee clientele in the developed markets, where they are getting those reference deals, where people are actually recommending their product. So they are competing with the Oracles and the Mices of the world. So they have finally come to a stage where they can compete. Now they are still not yet a cash flow throwing business model. So there's a little bit of chasm to cross over here. But having said that, if you believe that Indian entrepreneur and the Indian IT skills are here, and there is an explosion of IT requirement in the world. The nature has changed, more digital, more consumer facing, and more mobile, so and data analytics and robotics based. So you have to find companies that are positioned for the future.
FANG accounts for bulk of the market cap for Nasdaq, and we know that what's going on with some of the FANG stocks. If there is a selling in FANG stocks, because those are considered as product companies or consumer companies, whatever you want to define, could that have an impact on back home Indian IT product companies then?
Right now they are too small to make such a big difference. There can be a fall in the FANG stocks, and I've been constantly tweeting about it as well, that the valuations are on a high. So I don't think a fall in market caps over there will lead to second derivative impact on the IT product companies. No, it's too far-fetched. They are too small and inconsequential right now.
Okay. The second thing which you essentially like the financial inclusion as the mega trend, and within that you like small banks.
Yes.
Let's talk about it. Why?
Yeah. So just to give you a broad big picture. So in India has the largest pool of underbanked population in the world, and I am talking about huge. If just the underbanked population was a country, it would be the 8th largest country in terms of population. So all these, through this Jan Dhan Yojana and all, they have become part of the formal system. informal channels, because of demonetization, are going down and they are becoming part of the mainstream economy. Now, which are the businesses, which are the banks or the models that are going to cater to these people? I'm not necessarily talking about only people below the poverty line. I'm talking about bottom of the pyramid, which includes slightly below, let's say, 2 lakh annual household income. So small finance bank is one model which is positioned to cater to these people. The mindset is different. They have largely, most of them are convert from microfinance institutions. So their mindset is more of a service oriented. They're more feet on the ground. They're more accustomed to what the customer needs. They have gone through a crisis because of demonetization. They're just coming out of that. I think the base for them is very low. The runway is very huge over the next 10-15 year period. This is somewhat similar to, if you can imagine, you are starting out of buying a private bank in 2000, early 2000. Let's say you align with an IndusInd or a Kotak. That's the kind of runway. Now in hindsight, it is very easy to see, oh yeah, you should have bet on one of those private banks. So this is a private bank. A small finance bank is a stopgap arrangement. 5 years down the line, they'll be eligible for becoming a universal bank. They have built the cost into their structure of being a bank. They are yet to reap the benefit of the growth that the niche can provide.
So out of the 2 or 3 names, again, it's a very small universe right now. I just want to bring it out for the benefit of our viewers that there were microfinance companies which have become banks now, and they include Ujjivan, Equitas, AU Financial. So you're pretty much hunting in these 2-3 names.
So we have some private equity deals also, and of course 7 or 8 of those that got licensed and not are listed will be coming to the market in the next 2-3 years. The RBI mandate is to get listed within a 3-year time frame. So I believe the space will increase in terms of number of players also.
A year ago when I learned that you bought into consumer stocks, and my reaction was, I always thought Ravi was a value investor. He always focused on price, and he was never of the view that you should chase businesses. But consumer staples are expensive and you still own them. So it's a good call. I'm sure it's worked for you. But now where does that go? I mean, where do you think HUL, Nestle or the Maricos and the Mamis of the world are headed after the recent run?
No, you're absolutely right. They are expensive, and nobody can deny that. And today we are riding, we are probably from a larger wave point of view, we're probably still at the beginning of the consumption cycle. So what keeps me invested is the possibility that they can provide a 15% plus kind of compounded profit growth. So that's what we look at. See, there is no concern about the management or any such thing over there. Only thing that you are worried about is whether the business will grow 10%, 15% or 20%. That's what at the profit level, and that's what we are considering. So we believe that the trajectory for the next 5 years is still on a higher side than on a lower side for these businesses.